Welcome again. I've just got a few summary comments that sort of, I guess, reinforce what the chairman's just said, and then a bit of an outlook through some other items. But it was only a short time ago the prospect of a global recession seemed very likely. Most economists around the world were predicting the US to fall into recession this year, as central banks aggressively raised interest rates to control rampant inflation. However, the indicators are increasingly now pointing to an economic soft landing. So far, economies are successfully navigating the narrow path of lowering inflation through tightening monetary policy without causing a recession. In the US, the Federal Reserve has raised rates more quickly than at any time since the 1980s. Australia has also followed suit with 12 rate rises in quick succession, totalling 4%, and the official cash rate is now 4.1%. And while further increases are possible, we do believe we are near the top for interest rates in the current cycle. And like many of our other developed economies, Australia has been very resilient and has been largely underpinned by fiscal stimulus, government spending, and historically low unemployment. In addition, there's a large cohort of Australians that are benefiting from higher deposit rates, saving levels, and also asset prices. So over the financial year to June 30, Australia's share market defied most of these expectations and performed quite strongly. All industry sectors generated positive returns, although technology was the standout performer, surging more than 30%. Companies leveraged to lithium and other battery minerals also generated particularly strong returns. Meanwhile, sectors with more defensive attributes, such as utilities and healthcare, lagged the broader market. But following this strong performance, Australian investors seem less certain as we've entered the new financial year. So for the first 3 months to 30 September 2023, the S&P/ASX 200 accumulation index has fallen about 1%. Energy has been the best performing sector for the quarter, up 11.2%, versus healthcare, which continues to be weak, down 8.6%, and consumer staples, minus 5.9%. It seems quite a while now, I guess going back almost to COVID, that we've been calling the investment environment uncertain. Reflecting these conditions, companies provided little forward guidance during the recent August reporting season, and I'll elaborate on some of the key points from company results a little later. And we continue to see this uncertainty playing out in the underperformance of many smaller capitalised companies, as they're more likely impacted by higher costs, less scale, and a slowing consumer. So Argo diversifies its portfolio to maintain balanced performance over longer timeframes and deliver shareholders a relatively smooth dividend profile through the different market cycles. So our recent transactions have really been adding to existing holdings and reducing the overall number of holdings in the portfolio, although we have recently added one new stock, ResMed, which I'll discuss shortly. So we've recently exited 2 takeover targets, Liontown Resources at the Albemarle bid price of $3 per share, and Estia Health following the final dividend payment which exhausted their franking credit balance. And in addition, we've exited our holding in Insurance Australia Group and sold down positions in Helia Group and Diversified United Investment. And proceeds from these sales have largely been redeployed into several stocks, including CSL, which we continue to believe is an excellent quality company. CSL is now trading at more attractive levels than previously at a time when it's returning to double-digit profit growth. We also increased our holding in Viva Energy, following major shareholder Vital's sell down of 16% of the company, and we think Viva's prospects remain strong. There's currently an ACCC ruling on its proposed purchase of the South Australian-based On The Run chain. I see there's one just across the road, actually, of petrol stations and convenience stores. We also recently participated in a $750 million equity raising by APA Group to partly fund its acquisition of Alinta's Pilbara assets. Now, this included a portfolio of conventional and renewable assets, including a development pipeline of wind, solar and battery generation. Just a few comments about ResMed and I guess why now for us. ResMed has long been and is the world leader in continuous positive airway pressure, or CPAP therapy. It's the recommended treatment for most patients with obstructive sleep apnea, or OSA. So obstructive sleep apnea is a sleep-related breathing disorder causing complete or partial obstruction of a person's airflow. The brain senses this impaired breathing and causes the individual to subconsciously rouse from sleep to reopen the airway. ResMed manufactures and distributes these CPAP machines, and these are ventilators which deliver a continuous stream of pressurised air through a mask while the patient sleeps. Because obesity is a leading cause of sleep apnea, the recent hype around these GLP-1 drugs, or weight loss drugs as they're being called, and speculation that they're a cure-all for addressing obesity has led investors around the world actually to conclude that these medications will cannibalise or displace CPAP devices as a first-line therapy for OSA. This is reflected in ResMed's share price, which is down more than 30% since June 30. In our view, the positive impacts of these weight loss drugs are overstated. We've listened to dozens of calls from medical experts, both positive and sceptics on the drugs, and to be fair, the full impacts will not be known for many years. But factoring in some possible negative impacts on ResMed's sales, if obesity does decline globally, we still believe at these share price levels it represents a good buying opportunity. So we're happy to have it as a new name in the portfolio. Prior to COVID-19, a large percentage of listed companies provided guidance on forward earnings, the expectations of what they would earn over the coming 12 months or 6 months. Currently, very few companies give guidance. More commonly, they give trading updates at AGMs or investor days. And considering this, I wanted to give our insights from the most recent reporting season, which was through August into early September. Overall, the profit results, I guess, defied gloomy expectations, given headwinds from the slowing economy with rising costs, especially labour, insurance and interest costs. Revenues did show strength, though this often came from price increases rather than volume expansion. Declines in other input costs, such as commodity prices and freight costs, also helped to ease margin pressures. So companies generally provided conservative guidance, if at all, and this often disappointed the market and saw consensus earnings downgrades for companies. So for the broader market, consensus earnings expectations were revised down by 2.4% during the month and now sit at minus 6.6% for the 2004 financial year. On the back of this, I guess, or in line with this, Australian equities were soft in August and September, and that's continued into October, as lacklustre outlooks from companies have weighed on investors' minds. Interestingly, August was one of the most volatile earnings seasons in the past 15 years, with 1 in 8 stocks moving more than 10% up or down on the day of their result. The escalating cost of debt, we believe, is emerging as an issue, with higher interest payments a growing challenge for companies with stretched balance sheets or large refinancing costs. We believe this issue is being underestimated and could result in further earnings downgrades over the next couple of years as companies need to refinance cheaper debt. Overall, the August dividends were slightly disappointing, particularly from the large diversified miners, though not unexpected with lower commodity prices and higher capital expenditure. On average, the payout ratios are still below the pre-pandemic average, and we see a risk that the payouts actually edge lower as companies brace against a tougher economy, service higher interest costs, and potentially deleverage or pay off the debt on their balance sheets. Turning now to commentary from some of the bigger companies during reporting season, the Commonwealth Bank of Australia result was solid. Despite net interest margin and cost pressures, bad debts remain low in the banking sector, but have started to creep up a little in the non-bank lenders. There was evidence that competitive pressures may be easing, and while there was an air of caution, there was certainly no major concerns in the outlook comments from CBA. Wesfarmers, they indicated they were seeing no signs of weakness in their Bunnings or Kmart businesses. Woolworths noted that demand remains solid, although there are signs of customers switching to cheaper items on the shelf. The fuel retailers, Viva Energy and Ampol, reported seeing strong commercial demand for fuel, and even Domino's was noting signs of life in demand for pizza. Resource companies disappointed, I guess, with operating cost pressures coming through and labour availability remaining a key challenge. And we're also seeing this with further delays in project execution. There was over $5 billion in impairments due to cost overruns across the industry, including Rio's Australian aluminium assets, South32, Alumina and Fortescue's iron ore business. One part of the market that did do well was the global cyclicals. Now, they benefited from the weak Australian dollar, and this group of stocks was the only category that reported positive profit surprises in the June half. Also had the lowest share of negative revisions for financial year 2024 earnings. A combination of the higher quality, generally, of these global cyclicals and the translation benefit of the lower Australian dollar. Healthcare, again, had a mixed reporting season as the sector continues to deal with cost pressures, labour challenges and weaker utilisation of their services as the world, I guess, normalises still out of COVID. Some companies in the sector, such as Ramsay, are relatively highly geared and saw a significant increase in their interest costs. The real estate trusts had a decent reporting season. However, rising interest rates and the expiration of their interest rate hedges meant earnings declined for many of the Australian REITs. All in all, though, we think Australia's economy is faring relatively well in comparison to most other countries. However, as we look forward to next year, interest rates will have a slowing impact on the economy. It appears the first half of 2024 will be particularly weak, with economists expecting the global economy to eke out GDP growth of just 1.7%. This compares to this year's predicted growth of 2.3%. Geopolitical risks remain elevated and are increasing. As we approach the 2-year anniversary of Russia's invasion of Ukraine, there are a few signs there will be a resolution to this conflict, and more recently, a significant increase in hostilities in the Middle East has added to the geopolitical tensions around the world. The current investor sentiment indicates that Australia and the global economies should be able to avoid recession. However, in our view, further share market volatility is likely, and evidence of the economy slowing will emerge, leading to pressure on earnings. Australia retains very high population growth driven by immigration, and this should be a major economic tailwind for Australia in the coming years. However, on a per capita basis, the growth doesn't look so as impressive, which highlights the lack of productivity in the economy and the challenges with migration exacerbating the housing shortage issue. And residential availability and affordability are now key areas of community concern, and that's across the country. Look, we have no debt, we have cash available, and we have a diversified portfolio. So, we believe we're well positioned to navigate these, again, uncertain times, applying our conservative long-term investment approach. So I'd like to acknowledge and thank the whole Argo team again this year, few in number. Our staff continue to be fully committed to the success of the company across both our Adelaide and Sydney offices, and I think I counted 11 of the 16 staff are in the room today, so make sure you chat with them later. Also like to acknowledge the contribution from the chairman and the non-executive directors. I welcome the new directors to Argo, and I look forward to working with them as we best navigate Argo through this next period for you. And I'd also like to personally thank Roger Davis for his contribution to the company. And finally, I wish all our shareholders well for the remainder of the year. We look forward to seeing you in 2024. We thank you for your continued support, and I look forward to continuing the conversation then. So thank you very much.